Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Sonia Shenoy, and I think it's a painful start to the week, is the least that we can say for the kind of carnage. It's a full bear attack. Buyers are on a complete strike, and this is a global risk-off that we're currently staring at. Look at Nikkei now. That's down close to about more than 10%. It's a more than 8% fall for the Taiwanese markets and the Korean markets. And it's not that the US futures is suggesting that there is recovery in sight. The US futures are currently down. The Dow futures are down close to about 300 odd points. There are growth concerns in US. Earlier we were talking about a Goldilocks scenario perhaps with interest rate cuts coming, but now we're talking about a potential hard landing. There's a worsening crisis in Middle East. The India VIX also has shot up quite a bit. And I think now, Sonia, with the Nifty at the 24,085, we are 1,000 points lower compared to our all-time high just last week. Right, the all-time high was a figure of I think about 25,075 or 25,085. So just look at the way things have turned, right? 1,000 points gone in a few days.
It has, and I think this was expected, right? I mean, it was just a matter of time before this correction or this pullback would have come through, because if you remember, we haven't seen any sell-off in the market for at least over a year now, a year and a half perhaps. So I think everything came together. The US markets, selling off, the weak jobs data, the recessionary fears, and now our own markets as well. I look at this as a blessing because there are a lot of retail investors who never got a chance to participate in this up move. So perhaps at this point in time, although the ticker is looking a bit scary, there's no reason to panic. It's, just a matter of time before which this market will bounce back. Because remember, in hindsight, every global sell-off has been a great buying opportunity. But well, for now, looking at the ticker, things are looking a bit tough. But let's do one thing. I mean, the equity markets are going through a turmoil for sure. It is largely because of what's happening across the globe. But what's happening in the currency markets, let's also look at that. Manisha Gupta joins in to give us the latest there. Manisha, over to you.
Well, thank you for that. We are looking at a lot of movements coming in here as well. If you look at the dollar index itself, it has been declining for days now. It's trading at a 5-month lows. We've seen 103 give away in the Asian markets right now with the kind of sell-off that we are seeing in various other asset classes as well. So when you look at the last 1 month, just in sense of numbers there, the dollar index has declined by 2%. Much of those losses clearly coming in the last 1 week itself. So the Chinese yuan, the carry trade actually, by the way, seems to be doing quite well. You have the Chinese yuan trading at a 27-week highs. The Japanese yen, pardon me, is trading at a 26-week highs right now. The Korean won at a 9-week highs. We're looking at weak US jobs data. The numbers were quite dismal. And when you look at the manufacturing activity data as well, it has been on the weaker side in US, in Europe, and clearly in the Chinese markets there as well. But what the dollar index really seems to be losing is in sense of the sensitive currencies there. They have continued to decline into the markets. So you have the Mexican peso, which is trading at a 9-month lows right now. That one has declined by 5% in the last 1 month itself. If you look at various other commodity currencies, well, they seem to be taking it under the weather also. You have the New Zealand dollar trading very close to its 8-month lows. Australian dollar and Canadian dollar also trading at multi-month lows at this point in time. Well, most important thing to watch out from here would be the US PMI data for services that comes in today. And then, of course, on 18th of September, it is the US Fed policy meeting. The markets are factoring in 100% probability of a 25 basis point rate cut. And there is also now a 63% probability of a 50 basis point rate cut as well. So quite interesting as in a market, but we have seen a sell-off in currencies and in commodities as well in the Asian markets today.
Thank you very much for that. Prateek Parekh, equity strategist at Nuvama Group, is now joining in on the show now. Prateek, morning. Thank you very much for joining in. I think you all came out with a note just on 1st of August, and it couldn't have been timed better because you're talking about how India's valuations are at the highest that we've seen. Whether you look at market cap to GDP at 150%, this was the previous peak was in 2007 when the big fall in the Indian markets, we saw that big fall in the Indian markets. And you've also highlighted the risk of extreme drawdowns when we come to such extreme valuations. What's the market called?
Yeah. Thanks, Reema, for having me over. It's always a pleasure being on the show. So I think from a market standpoint, I think clearly things have gone a bit on the higher side. Whether you look at valuations on any metric, whether it's absolute market cap to GDP, whether you look at the breadth of the valuations, where median trailing P of a BSE 500 companies at 45x, which is almost 2x of 2007, or whether you look at relative to EM, where India is the only country which has actually seen a cyclical melt up I think things have gone very high. Now, at these high valuations, you either need the support of very large interest rate cuts or you need earnings momentum to sustain. Today, if I look at it on both the fronts, things are looking dicey. First, on the earnings part, clearly this quarter marks a decisive shift in the earnings momentum. Earnings, we have seen downgrades come through, but more importantly, profit growth is now reconciling with top line growth, and both of them are around single digits, which is not very comforting, at these valuations. But I think the large inflection points historically in Indian markets have come from global events. And I think globally is where there seems to be a regime change. For the first time in 4 years, we are seeing markets react to growth rather than inflation concerns. This, I think, is a big shift, and it will not be reversed very easily unless and until central banks go all out. There are, pockets of vulnerabilities on the global front where if delays are happen, and given how financialized global economy is, things could worsen of sorts per se. So I think from a market standpoint, we do remain a bit more on the cautious side, and we think that things are not are still very expensive, and global environment and earnings environment is moving on the opposite side per se. Reema.
Okay. Pratik, hi, good morning and thanks for joining us. It is an important day of trade, largely because, this is the first real signs of correction or pullback that this market is seeing after maybe 1.5 years, right? So what is the best way to approach it now? Do you raise your cash levels? Do you look for opportunities to buy into large cap names? Or do you just sit back and wait for this entire thing to play out?
Yeah, that's a great question, Sonia. And there are no easy answers for the same. But I think if you look at it, what I would do is definitely recommend increased cash levels, book profits in sectors where valuations are high and stocks have also run up a lot. And especially where earnings are very cyclical. For example, the industrial space, real estate space, autos, metals in India have seen a very strong rally. Which is very idiosyncratic and disconnected from the world. So you would probably book profits there. But nonetheless, I think from a medium-term perspective, we do still have opportunities in large caps, and especially on private banks and insurance. This is a space where we strongly recommend a buy on dip kind of an approach, where these are stocks or sectors which are trading close to the record low valuations. And I think earnings concerns also, to a large extent, are there in the price. I think this is a space where we think their absolute return can be made on a 3-5 year perspective. And I think that is where one should look to incrementally raise allocations. But broadly, yes, raise cash levels, deploy more money in debt, and book profits in cyclicals is our recommendation.
For those of our viewers who are joining us right now, the big sort of headline, the news headline is at the bottom of the screen, which is that the market, the Nifty, is broken below the budget day lows. I mean, we've all basically become accustomed to, used to the idea that whatever comes, the market is broadly okay and drawdowns don't last at all. I mean, it's been an extremely, and I think Pratik has been pointing this out as well, it has been an extremely unusual sort of market for the last 3-4 years with not even a 5% pullback, which should be par for the course in a strong bull market even. I mean, we saw that in between 2005 and 2007. There were lots of pullbacks. I mean, in the next 5-6 years as well. But I think ever since the low of COVID, I mean, we basically had a one-way market with very sort of few pullbacks along the way. Of course, I mean, late 2021, when the market topped out, that was the time around when some of these large IPOs were coming, like Paytm, etc. And then, of course, in the US, there was a bit of a correction. But even then, I mean, I think there was this sort of one phase of drawdown and nothing after that. So I think it's been a while since markets have, and that too in a synchronized way, taking a bit of a knock. The big talking point, the big story, which lies at the root of all of this, of course, is the fact that is the US, which has been the strongest market along with India, but of course for global markets is so much more important, finally going to see the so-called hard landing. So the consensus view was that it's going to be a very nice, gentle, slowing economy, which allows the Fed to cut rates, and that's the Goldilocks. So not too hard, growth still remains okay, slower. At the same time, it allows the Fed to gently bring down interest rates. So it's like a perfect landing, which has been thrown into question with the jobs data which came out on Friday. I have to say, though, it is just one data point. You look at the last GDP number out of the US, which came, that was strong. And I could point to other data points as well. But I think because the market in the US has been so focused on, the Fed has been so focused on labor market, and that missed in a big way, people are questioning whether it's going to be, that very gentle, soft landing. And they've raised the odds that maybe it's going to be a little more uncontrolled, not as well orchestrated, hard landing, recession. I mean, for example, the other talking point in the market in the US is, and these are serious economists who are saying whether the US economy is already in a recession. And one of the indicators which many have been talking about is a Fed economist who basically came up with this rule, which essentially says that if unemployment rates if unemployment in the US on a 6-month average basis, moving average basis, rises by more than 0.5%, you're basically in a recession. And by the way, the unemployment rate on Friday, along with the jobs data, came very, very close to fulfilling that condition. And that's the reason why many are kind of talking about whether the US is already in a recession. What kind of a recession, etc., is another question. Whether it's going to be a profits recession, which we've not had in the US for a long time, I think, and which can really hurt. Remember, we had a technical recession in the US. The market just looked through it. This was back in 2022. But we've not had a profits recession. It's too early to kind of sort of call that. Just one more point is, of course, what's happening in Nikkei. It's not so much about the Nikkei. We've spoken about, what's happened to the yen. The yen has gone from, is basically rallied 10%. I think we were at about 160 odd levels. We are at about 140 odd levels now. This is the USD JPY. So 160 to 140 means the yen is rising, the dollar is falling. That is, we don't know the size of the so-called carry trade, but because the yen rate differential and other sort of market differentials were so high, the yen was so cheap, and government bond deals in Japan were so cheap, and everything else basically was higher or much higher, the differential was very, very high. That is not the case anymore with the Bank of Japan starting on a rate hiking cycle, and that is the reason, that's the other fact, the other part, which I think is causing people to wonder whether Japanese investors will repatriate money back to Japan because Japanese assets are going to be much more attractive. But here again, the point is, will we, with what's happening on the Nikkei, with what's happening in government bond deals in Japan, is it a done thing that they will continue what they said they will do 2 weeks ago, which is a rate hiking cycle, or that is also in question? I think it's very possible that the Bank of Japan finds it very difficult to actually continue to hike interest rates in that country as it is advertised. So there are lots of moving parts. Markets are in a bit of a tizzy, a bit of a panic, but it's not one way, absolutely not. Both on the US front, a lot of recession word thrown around, and of course, with what's happened with this 10% rally in the yen and how much more you can see. I mean, I was talking to a global technical analyst who was saying that 140 is the bottom. I mean, it won't go, that's it. I mean, the market should rebound from there. So we'll see. But for now, I mean, actually, we're already at about 142.98. So lots of moving parts. But for now, there is a bit of a reaction, which is not a bit of a fair, bit of large reaction, which is coming through in some of these markets. Pratik, in terms of flows and the big thing which has helped markets, right, is domestic inflows, which is stayed rock steady. Looking beyond today, do you think some of this will be, the flow? Does this global narrative hurt local flows, local conviction? I mean, there's no way to tell right now, I reckon. But what's your best guess?
Yeah. So again, flows have been a bedrock of the bull market in India. I mean, that's why in India, we have seen a very cyclical, broad-based bull market, which has not seen any other market in the world. My only 2 bits on flows is that flows will eventually chase fundamentals. And if fundamentals deteriorate, whether it's because of liquidity tightening or because of earnings slowing down, flows also will reverse course. I mean, generally things don't go in a one-way street. In 2007 as well, we had very strong flows. But when the global tide turned, your domestic flows also turned. So I think only betting on flows may not be the right approach in my view. I think one should look at the fundamentals, global risk appetite, and the earnings, all of which right now are not in the best of the position. Now, as you rightly said, does this mean that markets will go one way down? Probably not. But nonetheless, it is still too early to call this a bottom and maybe have a buy on dip kind of an approach of sorts per se is what I would recommend.
Okay. Well, Prateek, thanks a lot for joining in. Appreciate your time here on CNBC TV18. Just before we let you go, just wanted to mention that, I mean, let's not forget that if you sort of take a bird's eye view of this market in the last 15 years, the Nifty has given 12-13% compounded growth rate, irrespective of any recession, irrespective of COVID, the pandemic, etc. Right? So, Prateek, do you think this time is going to be different? Or is that the way to approach it, that keep your shopping basket ready, maybe not now, over the next couple of months or so, and buy every dip? Is that the best way to look at it?
Yeah, Sonia. I think that's again a very important question. Yes, markets have compounded 12-13%, over the last 10-12 years, and irrespective of recession. And this time, one thing which is very favorable for the market perspective is the balance sheet. Corporate leverage is very low, so your ability to bounce back is very high. Unlike the 2007 episode of the past crisis where we had recessions causing balance sheet scarring, which took a long time to revive, that is not the case this time around. But nonetheless, as I said, in markets, there are always investing opportunities, whether in bull market or bear market. And today, the main opportunity in our view lies on financial space, where we think the private banks and insurance, these are the space where one should look to buy on every dip. And as and when markets valuations do cheapen out, I think there'll be more opportunities in the broader market as well. But for now, I think these are the space where we would recommend buy on dip, and maybe not so much across the board. I mean, we need to see how situation evolves, per se, honestly, on that front.
But Prateek, internally, you all must have discussed what's happening globally and what the screen is telling us for the last few days. Do you think this global sell-off extends itself? Just talking about the pure near term, what's your own guess?
See, I think it's very difficult to call out the near-term movements. I mean, central banks have been known to be very proactive. Ever since, GFC of 2008, they have been very, very proactive. And I'm sure at such market falls will bring about a reaction from them. But I think what is fundamentally different this time is that underlying growth has really slowed down. And to that extent, the policy response will have to be much stronger. And do keep in mind that if you look at the global growth backdrop, it was only the US where growth was very strong. If you look at China and Europe, growth hasn't really been that great. So I think it's very difficult to call the next week what will happen or tomorrow what will happen. But I think directionally, if growth does cool off, I think that is a bigger concern rather than just rate cuts coming through. I mean, rate cuts are always an help, but I think they do help only once rate cutting cycle is quite deep. In the initial stages, growth concerns dominate the market narratives a lot more, per se.
Just to give you an illustration of we were talking about the yen, right? A friend just messaged, he's also, by the way, in the markets. Yeah, he'd taken his son to Japan. He just returned from Japan for, I think he was getting a black belt. So he was in Japan till last week. He said, when I left India, yen was 160, 154 when I left Japan, 148 last week, and 142 today. So from 160, so I'm quoting with permission, no, of course, but 160 to 142. So that,
incredible.
I think it's just a very, very large move by any yardstick, right? And how many we don't see these at all. But Prateek, would you agree that it's been the market went up in such a fashion, such an unusually strong fashion. Nothing matters. Like I kept using the word Teflon coated because bulletproof, whatever you want to call it, right? That is not even very strong bull markets behave. I mean, we remember back in the day. You have decent pullbacks along the way and the market keeps going higher, right? Do you think this could be one of that, or are you now starting to say that, well, maybe we are at some sort of a high level, peak level.
Yeah. See, it's very difficult to call it, ex ante where we are. But I think if you look at the earnings dynamics and the global growth narrative, it gives me, I would tilt more that, there could be a bit more pain before eventually markets bottom out. It's difficult to call the near-term bottom and whether this pullback will be short-lived, because what is different this time versus the past pullbacks, I think, is the change in global markets narrative. Until now, markets were more concerned when inflation prints used to be higher and when Fed rate cuts used to be priced out. For the first time, despite increased probability of Fed rate cuts, markets are actually falling, which tells you that clearly growth concerns are dominating. And if history is any guide, these concerns are more painful and see a bigger drawdown rather than inflation concerns where you see volatility, but that's very short term. And eventually, once things normalize, markets rebound. Like, for example, what happened in 2023. So I think to that extent, unlike that we have seen in the last 1.5, 2 years, this time around, at least there is a bit more decisive shift in the overall market narrative is what I would say.
Okay, well, Prateek, it was good speaking to you. Thank you so much for joining us. And as they say, right, there's no point catching a falling knife in this market. So perhaps the best thing to do is to wait and watch. The markets generally take the stairs up and the elevator down, and this is pretty much what's happening. It is turning out to be a really tough day for the market. Almost 800 points gone now on the Nifty, something we haven't seen in a long time. But we're here to give you constant updates on the market and how things are going to be shaping up from here. So we'll take a quick commercial break. On that note, on the other side, we'll get you more market veterans, market views, and get you all the stocks that are in the news as well. Well, it really is a manic Monday of trade. The Nifty has breached the 24,000 mark on the downside, and it is over 1,000-point slide. I haven't seen this kind of a sell-off in very long. I think over a year now. In a single trading session, we've seen a fall of over 3,000 points on the Sensex. But it's interesting to point out that I think it was a matter of time before this would have happened, because our market was getting overheated, and there were signs of panic in the global markets as well. With the way, the jobs data, etc., was playing out. And now even Asian markets are selling off quite a bit. Soni Patnaik from JM Financial Services joins in for a quick technical check of the market. Soni, hi. Thank you for joining us. It is tough times indeed. But do you think taking a fresh short position makes sense at this point? Or do you just wait and watch?
Good morning, Sonia. Thank you for having me on the show. So I think you rightly pointed out that never try to catch a falling knife, and it's just wise to wait and watch over here. Nifty has broken 24,000, 23,800, 750 level. It's a good, important, crucial support zone. If there's a chance it must bounce back, it should do it from these levels. If it breaks, you can see it further testing 23,500, 23,400 odd levels. Similarly, Bank Nifty, it was supposed to test 50,000, 49,500 range as per a short rollover position from July to August. It has tested today, it has already tested. So it's going to be very important to watch if it's able to bounce back from these support zone, or even if it breaks this level, then it can hit towards 49,000, 48,200 odd levels. So I think that's the levels to watch out for. It's just wise to wait and watch and stick to stock-specific strategy and stay hedged when it comes to indices.
India VIX is up 60%. It's now approaching levels of 23%. Pull up India VIX, it's a 59.1% increase. More than a 50% increase that you can see in India VIX. Soni, you want to comment on the India VIX? And you said stock-specific is the best way to go about it. So what would the stock calls be?
Definitely. Good morning, Rima. So I think India VIX, it has seen a very significant spike towards 2021 levels, and any move above 16, it was already an indication that the markets could go into a correction. So I think today, tomorrow, anywhere between 2 to 3 days, it is going to be very crucial to watch if India VIX does not cross 23, 24. In that case, every rise will turn into a sell on rise sort of a strategy. So I think that's very important. Only if the VIX cools down from current levels and any move below 16, we can see markets trying to bounce back, may consolidate, may not cause much of a panic. However, if it continues to sustain above 18, 16 or 18 levels, then you can see the panic continuing. The volatility is here to remain and uncertainty will definitely rise. So coming to this stock-specific strategy, it will be a balanced approach, a buy and a sell idea. The first sell idea comes in Crompton today. One can sell in Crompton futures at current level, keeping a stop loss of 440 and a target of 415 and 410 can be taken. As Crompton breaks 10 and 20 EMA on daily charts today, giving a fresh breakdown. The buy idea is a conditional buy over here for Lalpath Lab. The condition is to consider a buy only above 3100, 3120 range. So Lalpath Lab is consolidating with fresh long positions on a positional basis. More than 10 days, it has been adding up fresh long positions. It is at a multi-year breakout as well. However, it is consolidating at this level. So the condition is to buy above 3120, keeping a stop loss of 3000 and a target of 3250 can be seen. So that would be the conditional buy.
Thank you very much for that. By the way, we spoke about India VIX up 50%. Japan's VIX is up more than 100%. You know, after that, market is down close to about 14%. But let's get to corporate earnings. Lots of news flow on that front. Bank of India reported their Q1 numbers. They've seen a 9.7% increase in the deposits. Net profits up also 9.8%. Rajneesh Karnatak, MD and CEO of the company, the bank, is now with us on the show. Sir, thank you very much for joining in. First, can you explain the improvement that we've seen in your net interest margins in the current quarter, and what can you guide going ahead? What explains the NIM improvement?
Yeah, thank you so much. If you see our NIM, it has registered a NIM. We have registered a NIM of 3.07% for June 24. This has sequentially improved. Actually, in June 23, it was much lower at 3.03, and in the March, it was 2.92. So NIM has improved. It is at the backdrop of our yield on advances, which has now touched 8.60%, an improvement of nearly 50 basis points. And cost of deposit is 4.82. So there is a gap of around 3.68% as far as between the cost of deposit and the yield on advances. This gap is also helping us in improving our net interest margins, which is now at 3.07%. As regards the guidance is concerned, considering the challenges which are there overall on the resources side and the cost of deposit which is rising, so we are giving a guidance of for March 25 a NIM of shade below 3%.
Okay. All right, got that. In terms of growth, right, loan growth, what are we looking at? Because I was going through your numbers in Q1. The NII growth has been about 6% quarter on quarter. Even year on year, it's a 6% growth that you're seeing on NII. Just asking you about overall loan growth for the full year, FY25. What are we looking at? And if you can break it up for us between corporate loan growth, retail, agri, MSME, where are you seeing revival coming from?
Yeah, so as regarding the credit growth is concerned, see, we have given a credit growth of around 17% on the domestic book, and overall in the global book, the credit growth is around 15%. For the guidance sake, considering the overall scenario, we are giving a guidance of around 13 to 14% on the global credit growth side. And as far as the mix is concerned, see, the mix will remain the same at around 55% will be our RAM book and 45% will be the corporate credit book. Within the corporate credit book also we are going for infra lending, industrial sector growth, and also on the renewable energy side. So these are the sectors where there would be growth. As we speak, there is a healthy credit pipeline with us of around 40 to 45,000 crores as we are speaking. So, and RAM also there is a healthy credit pipeline over there. Growth also has been good as far as the RAM is concerned. Agriculture has grown by 22%, MSME has grown by 13%, and retail has grown by 20%. Overall, RAM has grown by nearly 20%. So we are confident that the credit growth which we are targeting at around 13 to 14% on the global side will be able to achieve for FY25.
Any concerns on the asset quality? I can see your gross NPAs, net NPAs have actually improved. But some of the other banks or in the industry, there is concern about unsecured lending. What can you guide on asset quality and what is happening on the ground?
Yeah, as regards asset quality is concerned, if you see from our data, so gross NPA has come down in both in absolute numbers to 27,000 crores and in percentage terms to 4.62%. And it's a guided path which we are giving, and it is coming down on a sequential basis also. In fact, it has gross NPA has come down by nearly 2 percentage points on a YOY basis. As regards net NPA is concerned, for the first time we have come down below the 1% level. We are at 0.99% in June 24, which was more than 1% as on June 23. So there also we have shown improvement, and recovery also, if I tell you, as far as the bank is concerned, 1900 crore was the slippage in Q1 for the entire year, for this quarter, in fact, and the recovery that we have made is around 2700 crores, which includes cash recovery, which includes recovery from return of accounts also, and also recovery from the upgradation which has happened. So if we include the return of accounts also, so then this total recovery will be around 4,000 crores. So if you remove that, it is 2,700 as against fresh slippage of only 1,900 crores. So 1.42 is the slippage to recovery ratio now with the bank. So that also is improving on a sequential basis and on a quarter-on-quarter basis. As regards stress in the unsecured book is concerned, not much of stress is there. Our unsecured book, as far as the personal loan segment is concerned, we have a book of only 10,000 crore. That book also is mostly for the salaried class. In salaried class, majority of our loan book is for those accounts where the salary is coming with Bank of India, and the credit score in that is around 700 plus in the CIC number. So that also guardrails we have put. With all these guardrails, we don't see much of a stress over there. And as far as the NPA book on the this personal loan segment is concerned, only 40 to 45 crore I think is the NPA in this personal loan book. So we don't see much of a concern as far as the unsecured book for Bank of India is concerned.
So would you have a number in mind, the gross NPAs by the end of FY25 and net NPAs, what are you looking at?
Yeah, so 4.62 is the gross NPA which we have touched now. So we would be giving a guidance of around 4% of gross NPA. And as regards net NPA is concerned, so we will continue to improve this net NPA which we have reached at 0.99%. And we should be at around 0.90 by March 25.
Thank you very much, sir, for joining in. That's Bank of India, and the sell-off continues. There is no buying in sight right now. More than 3% gone on the benchmark indices, and Japanese markets have closed, and it's the worst day on record for them since 1987. We will get into a very short break. We'll come back and keep talking about this mayhem that we are seeing this Monday morning. Welcome back. Talking about earnings, which are expected today, the big one will be Bharti Airtel, and then you also have ONGC. But outside of that, many mid-caps, important ones, will be reporting numbers. You've got Marico, for instance, Bharti Hexacom. But let's talk about Bharti Airtel. Now, you know, Bharti's this quarter numbers assume less importance, because if you remember, the price hike, which was affected by the telecom majors, will be effective only in Q2. So in Q2 is when you will see the big jump in the company's revenues, margins, and in terms of the ARPUs. For this quarter, we're working with a consolidated revenue growth of close to about 2.5%. Airtel Africa has already reported numbers. So we will focus on the India business, and the India mobile revenue is seen up close to about 3%. The India margins are also seen largely stable at 55%. The driver for the company will be some subscriber adds. So according to our poll, subscriber addition should be close to about 3 million on a quarter-on-quarter basis, while the ARPU is likely to inch up a little bit from 209 to 212. But the big jump in the company's ARPUs will only come in the subsequent quarter when that 15% tariff hike comes into effect. So Q2, Q3 will be big quarters for the company in terms of the India margin improvement and the ARPU. But this is a number you should watch. Typically comes out at closer to about 4:30 p.m. Look at the US futures extending the sell-off now. Nasdaq futures is down 6%. The S&P 500 futures is down 3%. So it's
not looking good at all. In fact, it looks like it's only going to get worse through the course of the day. And in terms of individual stocks, right, everything that has rallied in the last maybe 6 months or so is coming off quite sharply, whether it's Tata Motors, which is down 6%, Infosys is down 5.5%. Tech Mahindra is down 6%.
But you know, these are also stocks which are indexed to global growth. So Tata Motors, for instance, or any of the IT names. So stocks where there are linkages. So metals are under pressure quite a bit. Pull up the Nifty Metal Index. That's where you are seeing, you know, the biggest cuts. Stocks indexed to global growth.
Absolutely. Even something like a Samvardhan Motherson, right? I mean, it has a large exposure to the global markets, and hence the stock is down almost 10% right now. We see this play out every time the market sells off globally, that a lot of these stocks get under pressure. Let's do one thing. Let's take a short commercial break. We'll get on you more on the markets on the other side. Don't go anywhere. Welcome back to Trading Hour. I'm afraid there is no respite to this market fall. At this point in time, there is still a fall of almost 700 points on the Nifty. The Sensex is down over 2,000 points, I think 2,400 points at the moment. But really, the fall pales in comparison to the fall that we're seeing in global markets. So the Taiwanese market has plunged almost 8.5%. The Japanese market has seen a fall of over 4,000 points in a single trading session, exceeding all its previous recorded daily declines. So in that sense, our market is not so bad. It's been resilient. It has arrested its sell-off up until now. But yes, it's really a global mayhem that we're seeing right now. But Divis Laboratories is one stock that we're looking at. The pharma company shares have dipped almost 2% on the back of its first quarter earnings. Ekta is here to give us a breakdown of the numbers. Ekta, over to you.
Well, the numbers were a tad below what the street was anticipating. So the revenue was up around 19%. Street was anticipating over 20% growth. Margins 29.4% versus estimates of 30%. Profit 430 odd crores versus estimates of 486 odd crores. But that was also because of higher tax expenses this quarter. However, the commentary from the company was positive this time. They say that they're seeing opportunities from the Biosecure Act. They're seeing opportunities from phase 2, phase 3 molecules. They are positive on the GLP-1 drug opportunity as well. And the management has maintained their growth guidance of double digits for FY25. Brokerages, Nuvama has upgraded the stock to buy. They are building on a revenue and profit CAGR of 20% and 31% respectively over FY24 to FY27. Jefferies has a whole target price of 4,830. They say Q1 was ahead of estimates. The management provided bullish commentary on custom synthesis and increased workflow on peptides. Antique maintains its sell with a target price of 3,264. They believe margin risks remain due to the upcoming patent cliff and ongoing price erosion in the CDMO business. PE-wise, it's expensive, so that's probably why you're seeing this shave-off take place as well. It's over 60 times FY25, over 50 times FY26, and over 46 times FY27 PE.
Okay, thank you very much for that. There's lots of important economic data coming out of the US later, today. You've got the ISM services data from US. Tuesday, you've got the trade deficit. So after the disappointing number that we got on the non-farm payroll data on Friday, the street will track the macro data very, very closely. Get into a break. We'll come back with more on the markets.
Okay, let's give the market check a break and cut across to Indigo's anniversary event. The company is celebrating 18th year of flying and is also going to be talking about entering the business class space, which investors promise could be, a big positive for the stock as well. So let's listen in to what the management has to say.
I want to assure the world that under the able leadership of Peter Elbers and his senior management, the employees at Indigo won't rest till we have made our humble contribution in ensuring that India has its rightful seat at the table of global aviation. Thank you, and I wish you all an enjoyable session previewing Indigo's new initiatives. Thank you, Peter.
Thank you. Rahul, thank you. And what a simple way of saying it. Affordable fares, clean aircraft, and on-time performance. But how difficult to do it, Rahul. Thank you.
Thank you.
That is Interglobe Aviation. I think they're celebrating 18 years of flying, and they're also going to be soon ditching their one-size-fits-all sort of model. They're going to have a premium class with roomier seats by the end of this year, entering into the business class space as well. That is something that is the big focus area for them and could help improve their profitability as well, as per what analysts have said. All right, let's move on now. The other stock to look at is SBI. It's been reacting to its Q1 earnings. In a conversation with CNBC-TV18, SBI Chairman Dinesh Khara commented on how the bank is positioned to move its yields forward and also commented on the impact of LCR on the lender. Listen in.
I hope that we should be in a position because whatever increase in deposit rates have also happened, even our MCLRs have also gone up of late, and we will be in a position to have the better yield on advances. Our yield on advances have already moved to about 8.86%, and we should be in a position to improve our yield on advances going forward. So that is something which will help us in ensuring that our NIM, we should be in a position to protect around these levels. We are having a pipeline is about 4.76 trillion, and it is equally split between proposals in pipeline and also proposals which have been sanctioned but awaiting disbursement. So I expect that, of course, when it comes to these corporate proposals, the disbursement takes some time. It does not happen immediately. But yes, of course, a significant portion of that, at least part of it, will be availed. This is what we expect. So I think I expect that we should be in a position to maintain our earlier guidance of about 14 to 16% kind of a growth and more towards 15% kind of a growth